So the accounting concepts. Accounting concepts are the underlying principles. These are the concepts or conventions on which the whole subject of accounting is based on. Yes, there are only two rules which are going to govern the subject, but yes, there are going to be quite a few, principles or concepts or conventions which are going to be kept in mind by us while talking about the subject, while talking about the depths of subject, while talking about the implementation or mechanics of the subject. We need to understand these concepts before we are going to implement all the accounting terminologies or all the accounting sets of rules and regulations. They are going to be implemented in coordination of these rules and regulations, of these conventions, of these rules or principles, which are to be kept in mind. Now, when we are talking about the first concept, it is called dual aspect concept. We were just talking about the accounting equation where we ascertained that debit is always equal to credit, which means that every time an accounting transaction is going to take place, every time money is going to be spent, every time a business is going to be started, every time income is going to be earned, it is going to be recorded twice, once as a debit entry and once as a credit entry, and that is what is dual aspect concept is all about. It is sometimes also called double entry principle, which means that every accounting transaction is recorded at least twice, once as a debit and once as a credit. After that, the second principle, it is called business entity concept. Now, a lot of confusion is going to be created if the owner is going to mix up his expenses and his assets with the business. So that concept, which is called business entity concept or single entity concept, tells us that the expenses and assets and personal incomes of the owner are to be kept separate from that of the business. Owner's personal expenses cannot be deemed as business expenses. Owner's personal assets cannot be deemed as business assets, and vice versa. What needs to be kept in mind is that business and owner are two separate identities, and their incomes and expenses and transactions should not be mixed up under any circumstances. The third concept, going concern principle. Now, you come across so many different kinds of people in your life. There are street hawkers, there are people who have temporary businesses, there are people who have seasonal businesses. This particular concept, going concern principle, assumes that a business can only be deemed as a business, it can only be taken as a business if it is started with an intent of continuing it for an unlimited period of time. So, the professional or the accounting definition of going concern principle is that a business has a perpetual succession, that it is going to continue forever, or the business is going to continue for its foreseeable future. That is going concern principle or going concern concept, according to which temporary businesses are not deemed as proper businesses. Then the time interval concept, which says that accounting records, they need to be maintained at least once a year. That is, yearly accounting records need to be maintained. It may be, they may be maintained twice or thrice or according to the need, but at least once a year they need to be maintained. That is where the concept of time interval comes in, which means that accounting records need to be maintained on regular basis or at regular intervals of time. The last concept of this particular video is historical cost concept. Historical cost concept means that assets are recorded at their acquisition cost or at the cost at which they are purchased. So, you are going to record the assets at their acquisition cost, at their purchase cost, and not at any other cost. There are quite a few more concepts that are to be discussed, which we will discuss inshallah in the next clip. I'll see you then.